All right, thank you everyone for joining and welcome to the Mark Taylor Q4 overview presented by Multifamily Metrics. My name is Christian Trujillo and to my right is
I'm Josh Salas.
Josh Salas. Yeah, you've seen us around. But anyways, so today, thank you, like I said, for joining. Today we're going to be covering our quarterly report from Q4 of 2024. As we're going through this presentation, keep in mind that we're going to keep the chat open. So if you have any questions, ask them in real time, live time. Our team will be answering them as we receive them. And then towards the end of the presentation, there'll be a few minutes as well for us to cover anything that we weren't able to get to. So as just kind of an introduction to the time here, we're going to be covering a few major topics, not exhaustive of our report, but some good highlights. So the development pipeline and absorption would be one, operations within the Mark Taylor portfolio, the Arizona economy as a whole, and then some employment. And we'll kind of wrap it all up, like I said, with some questions and overview on what to expect moving forward. So just quick housekeeping. So Mark Taylor, if you're familiar with us, or even if you're not, we're a developer and a property manager here in Phoenix, Arizona. We currently manage just over 32,000 units in the Phoenix MSA and a handful in Vegas as well. We are all of the data presented today here is going to be a mix of trusted third-party resources that we leverage on a daily basis and our own proprietary information that we've gathered and compiled over the last 20 plus years. So we'll be available to share this after the recording. And as I mentioned before, there'll be a little bit more detail on that as well. But to open us up, I think we're going to start first and foremost in the development pipeline and absorption, which is a big topic in Phoenix today.
Thanks for the introduction, Christian. So we want to take a look at the development pipeline in Phoenix, and the chart that we're taking a look at here is really just kind of breaking out all of the new supply we've seen since 2021. If you take a look at the blue bars at the top, those are just the monthly deliveries that we've forecasted, and then the orange bars at the bottom would be the excess units in the market. And really, the one thing that we're spending a lot of time looking at here is when are we going to see the supply pipeline kind of drop off as all of the units that are under construction here today are being delivered, and where is kind of the bottom of the market and where we start to see an uptick in rent growth and occupancy. So what we are forecasting here is going to be in the second half of the year. You can see where my cursor is. We're expecting this general vacancy of new supply to bottom here in the later half of this year. And as the new supply kind of trails off, we'll expect to see just kind of an uptick in occupancy and rent growth. Just kind of moving forward, one of the things that we do is track where this new supply is concentrated most. And if you take a look at the chart on the bottom, you can see that between Southwest, Northwest, and downtown Phoenix, that accounts for roughly 50% of the total supply. So with exception to those three markets, you have a more even distribution of new supply across the market, including Tempe, Gilbert, Chandler, Ahwatukee, Mesa, and North Scottsdale. So just overall excess inventory in those West Valley markets and downtown Phoenix markets. Another thing that we like to take a look at here is really just the trend of new supply in the market over the last cycle post-GFC. So one of the things that we see here is that between 2015 and 2021, as a market, we've averaged roughly 8,000 units of new deliveries. And since 2022 to 2025, we've averaged about 19,000 deliveries annually. So, over 100% increase in annual deliveries over that time frame. So overall, really just a lot of new product being delivered to market over a relatively short period of time, which has really just created that supply and demand imbalance that we've been tracking. From an absorption perspective, we've on average absorbed roughly 75% of all of those new deliveries annually, which if you take a look at some of the gross absorption figures in 2024, we're estimating that we absorbed roughly 15,600 units, which would be really double the annual average between 2015 and 2020 of total units delivered to market. So even though new absorption of this new supply has been robust, it's still not keeping up with the actual pace of new deliveries to market, which has really just kind of created some of that supply side pressure where there's just really an expanded general vacancy in the market.
Yeah, I think it's an important note, and you mentioned it too. It's our absorption has been strong. I think you see a lot of headlines of Phoenix absorption being strong. Nobody's really denying that, although it may be tapering off. But the new deliveries has been just that much stronger. So naturally, there's only so much we can do as a market, especially with the job outlook that we'll get into later in this presentation. But overall, not too gloomy of a picture, but definitely outpacing our demand with new supply.
Yeah, one additional thing here too is that we're forecasting just under 26,000 units to be delivered in 2025. And just based on our rough projections here, we're estimating 18,000 units of absorption, but that still leaves 7,000 excess units in the market, which is going to be really just kind of the last piece of the new supply into the market over the next year or so. One of the things that we think to be the saving grace of kind of all of that, excess supply would just be really constraints around the cost of home ownership. So if we're taking a look at this chart, you can see here that, the blue bars represent the average or the median mortgage payment in Phoenix if you were to purchase a home in any of these years. And at a 7% interest rate with the median home price today being $450,000, we're estimating roughly a $3,400 to $3,500 monthly mortgage payment, which is about $1,500 higher than the average rent in the Mark Taylor portfolio of $1,900. If we were to even just decrease that down to a 5% interest rate today, we're going to be still at $2,900, $1,000 higher than the average rent today. So even though, there's potential relief of, decreasing interest rates in the future, I don't think that there's going to be much relief from a purchasing standpoint for new home buyers. Another interesting note here is that there's been a big story headline of, rents have grown so much in Phoenix because they did grow on average about 30% between 2020 and 2022. But if you take a look here, it looks like the average mortgage payment has actually grown by roughly 12% annually. From 2015 to current, whereas the average rent has only grown by 5.8%. So almost double the growth over that same time period.
Yeah. Now we'll get into some Mark Taylor operations. So as I mentioned at the beginning, this is one of those more proprietary pieces of data, I guess. This is something gathered over about 20,000 stabilized units that we currently manage and compiled on our side of things. So I'll let Josh kind of kick us off on this too.
Yeah, I think some of the high level metrics that we like to focus on here are just kind of displayed on the screen. So occupancy, rents, concessions, rent growth, and a few other pieces here. But for the most part, the Mark Taylor portfolio is operating around 94% today, which is a little bit stronger than the broader Phoenix market where we've seen numbers coming around 93%. Market rents on average at the time that this report was produced was about $1,890. We're slightly higher than that today, around like $1,900. But what has been interesting and something that we've been tracking a lot would be the concession figure that we have here. From this same time in 2024 to 2023, we've seen concessions increase from 1.3% revenue loss to 3.7%, which kind of really fills us in on where that month-to-date effective rent growth number is coming from. So effective rents net of concession are down about 4.3% on average. So those actual in-place contract rents are only trading out slightly to the downside, whereas most of that revenue loss is coming from the concession just to kind of keep, these units moving. Overall, we've also seen a substantial increase in web traffic to the Mark Taylor website. You can see that from the same time of 23 to 24, we grew about 28% on average of just unique visitors to the Mark Taylor website. So from 32,000 to 42,000.
I think one other point as we're looking at this is our market versus contract rents. There's a extremely minor gain to lease in the portfolio today, but essentially for the last close to 18 months, we have had almost no loss to lease in the portfolio. So We're not, maybe slightly trading out to the downside for new leases. We're starting to see those renewals trade positively, but for the most part, it's not. We don't feel like we're missing anything as far as opportunities to push rents or any sort of strategies that would lead to that. It's mostly just holding on as the market continues to absorb these units and doing what we can to pivot and adjust as we receive them. But as of right now, market and contract pretty much in line, neck and neck.
And this table here is a snapshot of just recent submarket or recent portfolio performance divided by submarket. A couple of interesting things that are going on here is that on an annualized basis, you can see that infill rents have actually performed worse than suburban rents. But if you were to take a look at the month-to-date effective rent growth, we would see that suburban rents are actually trading out to the downside at a faster rate than the infill rents. One thing that is interesting there is just seeing the difference between demand for infill and suburban markets. And your infill would really be North Scottsdale, kind of that Camelback corridor in downtown, midtown, uptown, and our some more suburban markets, just kind of the periphery around that. Overall, stronger occupancy in infill markets, stronger rents as well. And then if you take a look here, one thing that's really interesting is North Scottsdale in particular. We actually have a positive loss to lease here of 3.3%. At the time that this report was published, these numbers were kind of pushing us in the right direction. If we were to take a look at where we've actually ended up today, roughly 5 to 8% positive lease trade outs in this North Scottsdale submarket. So we're starting to see signs of emerging rent growth, and we would expect other historically strong multifamily markets to follow suit, kind of being more of your North Scottsdale, Tempe, Chandler, Gilbert, Ahwatukee submarkets. And then possibly even in more East Valley suburban markets like Queen Creek, for example.
Yeah, I think the overall theme here is kind of not necessarily a new concept, but best performing markets being that North Phoenix, North Scottsdale, Southeast Valley, and pushing into Queen Creek and Apache Junction a little bit, but specifically in the Queen Creek area. But I would say strong demographics, high numbers of employment, access to major infrastructure in Phoenix. I mean, these are all things that have held true for the last 20, 30, 40 years, and they kind of remain that way today. So here's kind of a broad stroke at the Arizona economy. Again, as I mentioned in our full report, we'll get a lot more in-depth, and there's some more resources in there as well. But I guess a few high-level insights. Inflation has slowed just slightly, which is always a positive, especially when coupled with a 3.1% increase in Arizona GDP, and this was in Q3 of 2024. And then, overall, economy is getting slightly strengthened. I would say what's maybe not holding us back, but if there was an asterisk next to this, it would be the jobs numbers, which we'll get into in the following section. We're still outpacing the greater United States as a whole. About 33,500 jobs added in 2024. That does come up just shy of what we were projecting. But as I mentioned, still a little bit better off than the U.S. as a whole. So we'll move into, again, as a market, we'll touch on transactions as well. So we qualify this 50 units or greater, and this is just in the Phoenix MSA. 2024, we rounded out the year with about 51 transactions, so that's just about on par with 49 transactions in 2023. These are two of the slowest years since about 2008 and 9. I don't, so far year to date in 25, we're seeing pretty similar trends. Low transaction volume so far. I anticipate that changing later into the year and into 26 and 27. There's going to be some inevitable distress. We're starting to see some REO opportunities come to market, mostly in the B and C space. Some of the more institutional or even the private capital operators who are able to kind of take a hit to their balance sheet have disposed of certain assets in the last 12 to 24 months. But I think largely we're still seeing the can get kicked down the road, both from an operator's perspective and also from a lender's perspective. Just a little bit over leveraged on some of these properties that they're in, and eventually that something has to happen. Again, whether it's recapitalization, refinances, although if property values continue to compress and cap rates expand, we're not going to see too many of those refis going successfully or potential sales. So I think overall, we should start to see us climb out of this trough in the next 12 to 24 months, but time will tell, and we'll see what kind of opportunities that looks like. One last note on that. Historically, we've averaged about 130-ish transactions as a market, and we've also we've seen the 1970s, 1980s, and even 90s vintage buildings make up a majority of that sales volume. The last 2 years, overwhelmingly, the newer product, that 2010 to current, essentially, new development has been making up a majority of that transaction velocity. And again, I think that's because of the merchant-built philosophy of a lot of these developers, and also the fact that construction timelines have been pushed out. People are up against tight timelines with balloon payments on their construction loans, and just kind of fulfilling business plans and getting some of that capital out of the market. So as a whole, that's where we're at. And then we'll touch on employment. So as I mentioned earlier, about 33,500 jobs in 2024 were added. We were projecting about 45,000, so we came up short. And historically, we're closer to a 60,000 job per year market. So that is a little bit of a kind of a cloud hanging over the Phoenix market. I won't say it's bad. As I mentioned, looking at the greater United States, we're still in a good place. We've got some major investments recently announced, another $100 billion investment into the TSMC facilities in North Phoenix. That'll add another 5 fabrication facilities and thousands of jobs. So over the long term, that's going to be a net positive for the market. And again, I think we'll climb out of this in due time, just kind of slightly subdued for the time being. Any input on that one?
I think that maybe this side gives us a little bit more context into where we have been historically from a job growth perspective. So if you take a look here, there are more than a few lines here, but the dashed gray line towards the bottom of the range really just shows that we're kind of around 2% job growth annually. And for the most part, over the last 15 years, we've ranged from 2 to 4% with a few outliers around the COVID era. But we're not too far outside of the historical norm here. Basically in line with 2012 to 2013 job growth. So ideally, we're kind of at the bottom of this range and then look to climb our way out of it as we are in other sectors of the economy as well.
Yeah. So I think we've covered some development pipeline and absorption, operations, greater economy, including employment. As I've mentioned a few times now, the Q4, which you can reach out to either myself or Josh, will have some contact information included here. That'll include all of this information and more to a much more detailed level. And we're also happy to set up any time privately and separately to review specific submarkets, any pieces of real estate or investments you're considering making. But as of right now, unless we have anything else, we're going to answer some questions that may still remain. And thank you very much for joining. We'll catch you on the next one.
Yep. Thanks for joining, everyone.